Good day, everybody. This is Arlan Suderman, Chief Commodities Economist with StoneX, and we've got a lot to talk about today. In fact, when I put everything into my PowerPoint to talk about today, I thought, well, this will never fit in an hour's time. So I had to slash some things out and just tried to focus on some of the key points that were most relevant to this report and to the environment in which this report comes into. And so that may leave some questions unanswered, but hopefully we'll hit the high points, and hopefully we'll have some time at the end still to take your questions. Any questions we don't get to, then you can also direct message me on X, formerly Twitter, as well. And my address for that is on the final slide. But I also wanted to say that we have made the presentation available to you that you can download as well. You should be able to find it there. And if not, just reach out to us and we can make a PDF copy of the presentation available to you so you can spend some time studying it. We're happy to do that. So I should move ahead with the compliance slide and make sure I have that up long enough for all of you to be able to see it and to read it. Today's report was full of surprises. There were two big surprises, two primary surprises, I would say. One smaller than the other. The smaller one would be the wheat crop being bigger than expected. A bigger crop was expected, but it was much bigger than what was anticipated. And the other being how USDA handled the corn balance sheet. So we'll spend quite a bit more time talking about that. But first, we have some other things to talk about. And of course, price is a function of supply and demand as modified by the flow of money. So what about that money? We have gone now a full 12 months since the Fed paused its rate hikes. Now, if you look back at history, the longest the Fed has gone after pausing rate hikes without a rate cut is 18 months. That would put it at the end of the year. Right now, the market is anticipating, well, and I checked earlier today, it was putting like 93, 94% odds of a rate cut in September. So we'll have to see if that happens. The data of late has turned more favorable for that to happen. With a CPI number, consumer price index numbers continuing to work lower. If you look at the headline number we have right here, right at 3%, that's the lowest we've been in exactly 1 year. Exactly 1 year ago, we hit 3%, and then we bounced, and we finally made it back to that level now. So will we bounce again, or will we continue through that level down to the 2% mandate level? Core inflation, which is minus food and energy, the more volatile food and energy, is sitting at 3.3% right now. Does that continue lower? That's going to be one of the keys to getting headline inflation lower as we go forward. If you break down the CPI numbers, and these are year-on-year numbers, and I want to thank Mike Blackford for putting this together here at StoneX. Motor vehicle insurance has been one of the big causes of inflation to be sticky. And the Fed has very little control over that. Right below that, it's tobacco and smoking products, motor vehicle maintenance and repair, rent a primary residence, electricity. Now, rent prices are finally making their way lower. We're finally seeing a softening of that market. Now, on the negative side of it, helping pull things down, we're seeing used cars and trucks, airline fares, motor fuel, new vehicle prices. Now, airline fares particularly has been somewhere we've seen a lot of volatility, and of late they've helped kind of offset some of the insurance, but we've even seen a pullback in the insurance and late as well, if I'm remembering the numbers correctly. But this gives you kind of a visual representation of where we've seen inflation over the last year as a whole. Now, as we go forward, the producer price index data came out today, and it was more hawkish in nature, pushing higher. Now, the headline number came in at 2.6%. That's much higher than what the trade had been expecting. The core number at 3%, much higher than what the trade was expecting. If you take out trade services, the numbers were pretty much as expected and pretty flat. Now, trade services only accounts for about 10% of the total, but it had a significant impact in June. And you get a lot of volatility with trade services because there you're looking at the margin between the price that a company pays and the price that the company sells it for. And so you got two prices moving, and that can create some volatility. And so what Wall Street did today is saying, well, this hotter than expected PPI number was just due to the trade services numbers. And we're going to give it another month or two to see if this is a new trend that's going to work its way into consumer price index later on, or if this is just an aberration. And so Wall Street chose to take a positive view of it. We saw Treasury yields initially pop when they saw the initial numbers, but then trade much lower. In fact, we're looking at 2-year Treasury yields traded to 4-month lows today, essentially. So we're also really narrowing the yield inversion between the 2-year and the 10-year as they're getting closer together once again. Long term, I haven't changed my attitude. I still think the long end of the yield curve that the Fed is losing control over that gradually. It's not at all, it's an ebb and flow, but that's the trend due to out of control fiscal spending by our Congress. And I took a lot of that out of this presentation because everything else that we have to talk about here today. But I do think that is increasingly a problem right now. If we look at the cost of servicing our debt on an annual basis, it's up to about $889 billion. $889 billion. And every time I update my presentation, and I do more presentations than just these monthly ones, every week I have to update that because it's going up so fast. And we're starting to see some signs of the credit markets tightening. Now, people will argue with me on that, but there are some beginning signs of that starting to happen. And I think as we go down the road further, we're going to see that momentum start to pick up. And eventually, I think that's going to force the Fed out of its balance sheet reduction mode that it's in now. It's already reduced the pace at which it's reducing the balance sheet. And I think it's going to have to all the way eventually bring that to an end and maybe even start quantitative easing again or monetizing our debt again to try to keep a lid on those interest rates. Enough on that. How's it? Well, one other thing I want to show you, we're still looking at this trend toward an expanded balance sheet, even though the Fed is reducing balance sheets now. And this is largely because of the fiscal stimulus we're getting from Congress, as well as the executive orders for student loan forgiveness, in my opinion. Now, as we look at TSA data, people are traveling. We're back to essentially pre-COVID levels or higher right now. People continue to travel through TSA checkpoints on our airlines. If we look at the jobs numbers, and Fed Chair Jerome Powell told Congress this week that the jobs market has softened quite a bit and it's now in balance, I think is a little bit premature to say it's in balance. And I'll give you this chart as an example. We're still at 1.22 job openings per person looking. That's still slightly inflationary. It's much better than we were when we were a little above 2 jobs openings per person looking, but it's still a relatively tight jobs market. A 4% unemployment rate is still a relatively tight jobs market. So, you know, I still think we have a problem there, but we're moving in the right direction. And I think the way the Fed sees things is holding the line on its current policy is working, and so they're going to be patient to do so. And the economic data remains resilient enough to give them the time to do so. So I don't even think a September yield cut is guaranteed, but I do think the Fed wants to be able to hand the people of the United States a rate cut, and they don't want to do it too close to the election. They're probably not going to do it in the July report, but I would look for them at their July meeting at the end of this month for them to start using the language that opens the door for that September rate cut, and then adding to that at the Jackson Hole, Wyoming meeting at the end of August, and then the September going ahead with that rate cut if the data stays on the trend it's on. We'll have 2 more CPI reports between now and that September meeting. We'll have 2 more monthly job reports between now and that September meeting. So a lot could change, but that's the trend we're currently on right now. And if you look at, and I apologize, I didn't get this updated, but when you look at the CPI numbers that we got this week, that has caused the 5-year break-even inflation rate to start breaking lower once again. It's still above that support line, and the latest time I looked at it today, same thing on the 2-year break-even as well, but it's moving back down toward it. And so what we've done is we have taken away the reinflation support that we had in the commodities, especially the grain and oilseeds now. And so the funds are quite comfortable being short the commodities again, and why we have record to near record short positions in the grain and oilseed markets once again. I do expect the reinflation pressure to come back as we get closer to the end of the year. But in the meantime, these grain and oilseed prices are pretty vulnerable from this standpoint. And here you see the chart I show you. The correlation is still strong on a 10-year basis of 0.87. And the grain and oilseed markets are working their way back lower. This is the broader commodity index. Here is the grain and oilseed sub-index, and you can see that it is breaking lower. Let's talk about the weather, because there's a lot to talk about here as well. If you look at where the major corn belt is at this point, you're really looking at this region right in here for where the 85% of the nation's corn is produced. So that's the focus weather-wise. This looks at rainfall from mid-April, basically April 15th until July 10th when I made this graphic. And you can see that the areas in northwestern Midwest where they've had all the flooding have had the wettest time period for that particular time of the year. The first half of summer and the last half of spring, really, the wettest on record, last 132 years. And even in eastern Missouri and western Kentucky, it's been quite wet as well, but much of that came just simply in the last week with the remnants of Hurricane Beryl. Now they've had other times of rain, but that really added onto it and boosted their rankings when we had that come through. East Texas is an example where they had their annual rainfall by mid-May, I believe it was, and then now they've added to it, and that's where Beryl's remnants went over as well. So how does this compare to 1993? So take a look at this graphic, and now I'm going to flip the same time period for 1993. Notice that 93 wasn't as wet up here, but this whole wet area shifted a little bit further to the south and to the east. So that's a poor arrow there, isn't it? Anyway, we shifted that more to the east, covering more of the core production area in 1993. But now let's take and let's add another few weeks to that. Let's go out to, what is it, September 24th, or July 24th, I'm sorry, July 24th. And notice now how much of the Midwest is covered by top 5 wettest on records. This is 1993. So this is pollination time. And this is where the heavy rains really got going and where we did most of our damage, centered on Iowa and surrounding areas. So Iowa, eastern Nebraska, southeast South Dakota, southern Minnesota, much of Illinois, much of the most productive part of Illinois. It's just persistent heavy rains. And as I've told you before, it reduced the amount of harvested acres in Iowa by about 700,000 acres, which is a little over 4% of their planted acreage. So that wasn't the big hurt. The big hurt came in reducing yield by about a third from these persistent rains during that time of year when it leached nitrogen. It caused denitrification in the soil. The roots could not get oxygen because the soils were saturated. And that all hurt yield. And so that was a big problem for 1993. So I continue to argue that while this year is a problem, particularly in southern Minnesota, southeast South Dakota, northwestern Iowa, it was a real problem. And for those of you in that area, I don't want to understate the problems that you encountered and the losses that you have experienced. And most of it from ponding, but some affecting others, and of quite a variable crop, et cetera, the replanting that happened, et cetera. Those are problems. But to this point, the rest of the Midwest right now is having a great year and to a great extent offsetting the losses in that area. Now that may change as we go forward. And I think one of the biggest risks going forward is that all that humidity that's feeding on the northwesterly flow over that area that flooded will continue to give us thunderstorms, high nighttime humidities that hold nighttime temperatures elevated, and that can hurt yield. We saw that really play out in 2010. I'm not saying that's going to happen. I'm just saying the risks of that happening are there, and particularly as we get into late July and into August, that's a risk that we need to watch. And I think as we look at the weather pattern right now, and I line up the various risks that could potentially shrink the size of this crop, I already think that we're going to see a reduction in harvested acreage because of the problems in northwestern Midwest. But I think a bigger factor potentially could be the high nighttime temperatures. I haven't found anyone to agree with me that yet, but that's a risk that I'm certainly going to be watching going forward. Now, as we look at soil moisture levels, we can see a lot of very saturated. This is the top 16 inches of soil here, and we have dramatically improved things in the central and eastern Midwest. We were already starting to improve it. Hurricane Burrow went a long way toward helping do that. We still have some dry pockets. Certainly Kansas is dry in the areas. We have some dry areas in the Ohio River Valley, certainly as a case, certainly in the mid-Atlantic, but we have dramatically improved things. And I think as we go forward, we're looking at a drier outlook for the northwestern Midwest where they've been so saturated. That will help. And some warmer temperatures as well. They've been way behind in heat units for that area of the Midwest. And I think we're going to start moving in the direction of trying to correct that to help the crop catch up. The good news for you with the lack of heat units is if you look at these transition years toward La Nina, this is not a guarantee. This is simply a historical tendency. The historical tendency would be for a late frost. We'll see how that plays out this year, but that's the historical type of a tendency. And so giving you more time for those crops to develop, plus the added heat units that you're going to be seeing, I think, in the weeks ahead. If we look at those average temperature ranks, and I did shorten this up to be more reflective of when things got planted, et cetera. This is basically the first half of the summer. You can see how cool it's been in the northwestern Midwest relative to other areas. But goodness, look how hot it's been in the desert Southwest, how hot it's been in Florida, one of the hottest summers on record, as well as really from the mid-Atlantic north through New England, very hot as well overall this summer. Now, I want to talk a little bit about this weather pattern. We still have these very hot temperatures here south of the Gulf of Alaska. Right in the Gulf of Alaska, we're still cool, and that's a key. I've talked about that before. But you see where I put the X, where it's been hot in the mid-northern Pacific. Also here in the northern Atlantic, very hot. You can barely see my red X there. It's so red and hot. So historically, that means we would typically get a high pressure setup somewhere in between that. And we talked about in previous webinars, where would that be? Could be anywhere from here in the southern Midwest to the northern Midwest to the desert Southwest. And that would have a big impact on the type of pattern we have for pollination, grain fill, pod set, and pod fill. So looking at the updated weather models today, what it looks like it's really going to try to do is set up right here in the Four Corners area. And if it sets up that high pressure in the Four Corners area, it doesn't look like it's going to be definitively there all the time, but that looks like the place that it wants to park based on today's models. That tends to give you flow. First of all, helps keep these high pressures, help keep the jet stream to the north quite a ways elevated, but you tend to get northwesterly flow across the Midwest. And with the amount of humidity you have in the air, particularly in the northwestern Midwest, from all the excessive rain in that area this year thus far, you have it to where it feeds the atmosphere with moisture. Northwesterly flow in the summertime tends to generate sporadic thunderstorms and sometimes cluster storms. And if you get enough frequency of that to where everybody gets them on various days, you start to fill in dry areas and you get that. And that tends to support good yield potential. So is that the way we're going to line up? Right now, that's still looking to be the case. We'll see how it plays out. I would say confidence is not high, but right now that's our best guess of what we're going to be. We're still seeing La Nina develop here with these cooler waters in the equatorial Pacific, but it is so slow in developing that it is a lesser factor in influencing weather pattern. The bigger factor is the cold in the Gulf of Alaska with high pressure just below that and the warm temperatures just below that, combined with the high pressure in the warm sea surface temperatures in the northern mid-Atlantic. Those are the two primary driving factors right now, much more than La Nina. We're still expecting La Nina to develop in the last part of this year, and that could end up creating some problems for South America. Overall, right now, the longer-term European models are calling for a dry start to the planting season in Brazil and then a more favorable growing season after that. So I don't think we can assume low yields. In fact, one major private consultancy in Brazil today released their updated 24-25 production estimates, putting next year's Brazil crop 171 million metric tons. That's huge. My estimate had been 165 million metric tons. And they put corn, I forget the corn number now. Let's see if I can find it real quick. They put all corn production at 125.6 million metric tons. That's a little bit higher than I had it as well. They're a little bit more optimistic on returning to yield with La Nina developing, but that potential's there. I can't argue against it. That is certainly there when you look at the variability in the history of Brazilian production in La Nina years. So that's definitely something we have to respect. If we look at the next 3 to 4 weeks in the United States, so this is looking now into the first couple of days of August, we're basically looking at a hot period of time. No secret, we've been telling you about that. Much of that, though, I think will be in high nighttime temperatures, which is what I've been warning about. But this basically assumes that we get high pressure somewhere in this area, and you get the monsoonal flow around it, and you get this northwesterly flow up across the Midwest. The question is, does this develop thunderstorms? The models have trouble picking up on that. That's just historically what you see happen. The models don't forecast it, but you get it happening. But we'll have to see exactly, do we get the high pressure setting up there or do we not, and how's that flow? The other factor in here is the Bermuda High is now getting more established out here. And That flow comes around it and pumps moisture into the southeast where they badly need it right now. Hopefully they will be able to get some of that moisture, but it also continues to pump moisture up here into the Midwest to feed off of that northwesterly flow as well. If we look globally, we had been extremely wet in this area of China. Those rains have now moved north into the North China Plain, where they were very, very dry and hot in the month of June. The first 10 days of July have been among the wettest on record now for those areas that were hot and dry in June. Commodity Weather Group found 3 other analog years that were very similar in weather pattern, and they ended up all having above trend corn yields. Soybean yields, 2 of them above trend, 1 below, and that was a year in which August turned off dry for them. Notice a steady flow off of Alaska, the tropical moisture there, suggesting continuing to feed hurricane activity, feeding here into the southern and eastern United States as well. If we look at South America, seeing this very wet flow, unseasonably wet flow into parts of southern Brazil as a stalled out front in that area. More normal precipitation perhaps in some wheat growing areas of Australia. But look also as we go up here in the Black Sea production region. Very dry, and I'm going to show you in a little bit, also very hot. The winter wheat crop is done. The spring crop, though, can be stressed by this, and their corn production in Ukraine and Russia could also be shortened. It's under a lot of stress right now. So let's look at temperature, and you see how warm it is in that same area, hot and dry. You look at very mild temperatures here in the U.S. Midwest, very hot in much of Europe. Argentina, very cool. In fact, we're looking at possible frost in southern Brazil, but we don't expect it to get quite cold enough for frost at this point. Argentina, pretty cool. That helps take some of the stress off their wheat crop, which has been quite dry, trying to get established. And we're going to have to watch Argentina's production potential there. When I look at that Black Sea production, it's most under stress of heat and dryness. This is our NDVI values, and you can see here that NDVI, which is satellite measurement of the health of vegetation, is still within the 20-year average range, but it's well below average. And that's a real concern for the corn crop and the spring wheat crop in Russia. If we look at the North China Plain, you can see how we have recovered with these rains here in early July to where we're above average NDVI values now. I wanted to show you this map, though, to give you a little bit of an idea. This is Iowa. We have Minnesota up here. To see if I can do an M. That's southern Minnesota. We have Nebraska, a little more room to work there, and South Dakota. All right. This is the area up here where we saw the greatest amount of flood problems in late June, third week of June or so, somewhere in there. Notice how you can see it on the satellite images. That is really showing the poor crop health, the ponding, etc. And that, I think, is going to result in reduced harvested acreage. But also, look at these hail strips here in Nebraska. Look at those hail strips where we've done some significant damage to the crops in the Platte River Valley. Look at this flooding impact along the Missouri River Valley, and the name of this river, South Dakota River, really escapes me right now, but there's some areas in there where they had widespread flooding. So we're going to have a big drop in harvested acreage in that area. What will it be nationally? I've heard estimates of 3 million acres. I think that may be on the high side, but I can't rule that out. Right now, I think it'd be a reduction in harvested acreage of maybe 1 to 2 million acres. But when you take these 4 states and you look at them, combine them for NDVI, NDVI overall is above average, lower than last year, but above average, because you have very good conditions elsewhere away from that. The exception being Minnesota. Minnesota has below average ratings all the way across. But Minnesota is one of the few, if not the only state, major production state in the nation, with the NDVI levels coming in below what would be the 20-year seasonal average at this point. But I did want to show you that because I thought that satellite image was pretty enlightening. Okay, looking at today's wheat production number. There's no other way to say it. That's coming in 100 million bushels above the average trade guess. I was above the average trade guess, and it was well above my estimate. In fact, it was above the highest of the trade guesses. Winter wheat crop coming in, what is that, 25 million bushels above the average trade guess. The hard red winter wheat crop coming in 20 million bushels above. The soft red winter wheat crop, the trade really nailed that. I had it a little bit higher. White winter, 234 million bushels above the average trade guess. Durum above the trade range at 89 million bushels. Other spring, which would be hard red spring, and the soft white spring and hard white spring, all combined, came to 578 million bushels. That was 57 million bushels above the trade estimate. That's over 10% above the average trade guess. And this was the first actual spring estimate of this marketing year. So that was the bearish surprise there in wheat production. Not that it was higher, but that it was higher much more than expected. And I'll break down those numbers here in a little bit. If we look at South American production, we saw a 1 million metric ton in Argentine corn, a 500,000 metric ton in Argentine soybeans, and that's it. No change to Brazilian production. If you look at U.S. yield and production, no change really, pretty much as expected. The corn number came in slightly different overall than what USDA had been in the past, and a little bit higher than the average trade guess, but the average trade guess was looking for a slight reduction in yield. Same with soybeans overall. So no real surprises there in U.S. production numbers. U.S. ending stocks is where the big surprises were. Wheat, because of the higher production number, come in with higher ending stocks. Nothing friendly about that. Soybeans, if you look at the June 28th report and you look at today's report, basically USDA hasn't changed anything for soybeans. But it basically says, here's the bottom line. We have an adequate supply of soybeans. It's not immune to a weather problem here over the next 60 days here in the Midwest or to South America as we get into their growing season. But until such a weather problem develops, there's no reason to sustain a rally to ration demand. Rather, we could use some lower prices to get rid of some supplies. And I know as producers, you don't want to hear that. You want to get rid of the supplies without lowering prices, but that's the reality of economics. The big story, though, is this corn number. Look at that. Coming in 215. I was saying 300, so I was remembering this number wrong. I got it mixed up with my number, 2.89. The average trade guess is 2.312. So that's coming in nearly 200 million bushels below the average trade guess. That's a big miss, 215 million bushels to be exact. That's a big miss. That was below the lowest of the trade estimates by almost 80 million bushels. That's a huge miss. The fact that the market didn't respond more today tells me that A, the trade doesn't believe USDA's number, or B, they say, so what? That's still 2.1 billion bushels, so we don't need to ration demand. Or, hey, the farmer still has so much corn to sell over the next 60 days. We don't need to worry about our big short positions, because if the farmer comes in to sell, that's when we can unwind our short positions. And we don't need to worry about an overnight rally that would cause our problems to eat away, our profits to eat away, unless we see a sharp turn in the weather toward adversity. So that's kind of the story why corn prices, while a bullish surprise, was really kind of a neutral market reaction. And it's because the farmer still holds so much corn, and there's some skepticism. Now let's talk, and I'm sorry, I've been talking all day trying to keep my voice. Let's talk about these numbers a little bit. The June 28th stocks report, stocks came in 100 million bushels above trade guesses. That means that either A, USDA understated the size of last year's crop, which I covered in the June 28 webinar. And I said at that time, they're not going to adjust the size of that crop until September. Or they overstated usage, and ethanol exports, most other uses are measured. We know what they are. So that leaves feed usage. Well, feed usage has been strong. You can make the argument for their feed usage numbers, but if you do that, it can't balance it with their stocks number. And so how do they do that? The trade was expecting them to cut feed usage, and then maybe in September they increase the size of the crop, and then they elevate feed usage back up. They didn't do that. They just elevated feed usage for this year and for next year, because anything you do with the feed usage this year has implications for next year as well. Now, feeding economics favor feeding to higher weights right now, and have for a while. So I understand that. I get that. Cheap prices create demand. I get that overall. They also raised exports by 75 million. And I've been telling you that our marketing year-to-date exports have been above the pace needed at USDA's target. But I do think they overshot that. I think 75 million is too high. If you look at their new target right now and what marketing year-to-date inspections are, they trailed the pace needed to hit the seasonal pace needed to hit USDA's target by about 41 million bushels. So USDA went too high on the exports. I think they'll end up coming back a little bit on that, but they still got to make the balance sheet work by that September 30th report, which is when the next stocks report comes out. So I'm not a big fan of how the USDA did it. And in fact, if you look at their ending stocks number and what they did, it really looks like they were trying to solve for an ending stocks number below 2.1 billion. And when you do that, it eventually catches up to you. Just saying. I can't prove that. I don't know that to be fact. That's just my opinion. But that's a risk if you're still long corn, and something to be wary of and something to watch for. Enough said. Global stocks, virtually no change on corn, virtually no change on soybeans. The big change was wheat with the increase in production in the United States. If we look at ethanol corn usage versus the seasonal pace needed to hit, we're basically on pace. If you look at exports, we're now trailing the seasonal pace needed to hit USDA's target by 41 million bushels. Even though we've had very strong sales to Mexico, up 45% year on year. New crop sales, though, are really hurting. And it has me worried about USDA's export target for the new crop balance sheet. And you'll see that in a little bit when I show you in balance sheet. When you look at crop ratings, look at how many states their condition index score is above the long-term average. Minnesota is the one state where we're dropping below it at a fairly rapid pace. But even North Dakota, South Dakota, Nebraska, Iowa, we're above the longer-term average. North Carolina certainly has problems with their drought there. I grant you that. That's been pretty tough in that area, but it's not a major production state. So can we still hit that 181 bushel trend yield? Yes, we can. Doesn't mean that we will, but right now the data says you can't rule that out. You can't rule out something above 181. That's why USDA stuck with it today. My export target is better than 100 million bushels below USDA when I do my world balance sheet. And I think USDA is simply overstating it. Even my old crop export target is now 50 million bushels below USDA. I probably need to elevate that a little bit more, but whenever possible, I try not to change my balance sheet on my end. I change the USDA numbers to fit the USDA report, but I want you to see what I've been working off of prior to the report in most cases. I say South America could change this export number. Black Sea could as well, where it's hot and dry. Ukraine is the world's fourth largest exporter. We basically, this does not reflect today's numbers that came out just about 10 minutes ago while I was talking to you. I anticipate it'll show net managed money position at record short positions. Weekly soybean shipments versus the seasonal pace needed to hit USDA's target exceeds the pace by 28 million. Now I've got two arrows on here. Typically we trend higher through the rest of the marketing year as Brazilian supplies start to dry up ahead of our harvest. I don't expect that to happen this year because Brazilian supplies contracted today are still cheaper than U.S. supplies all the way through September. And so if we just stay flat here, that's when we'll see this number dissipate. I'm still about 5 million bushels above USDA. We'll see where we come out. U.S. soybean export sales to China are down 22% year on year. New crop sales are nearly non-existent to China. Very, very small for this time of year. If we look at crush year to date, it still exceeds the pace needed to hit USDA's target by 30 million bushels. We have a very critical crush report coming out on Monday that'll give us some idea of where we're heading from this point. Soybean conditions scores, very similar story to what we're seeing with corn. If we look at our soybean balance sheet, again, my crush number for old crop and new crop is higher than what USDA is. My export target for old crop is a tad higher than USDA. For new crop, it's 90 million bushels less than USDA. My new crop ending stocks are 468 million bushels. A 5% decline in yield drops ending stocks down to 246 million bushels or 5.7% stocks to use ratio. And that gets down to the area where the market starts getting nervous. If we look at fund positions, again, today's numbers aren't on here, come out while I'm talking to you, but overall we're moving toward record short positions once again in soybeans. Spring wheat condition scores are very good. One reason we saw the big jump in production estimates, if we look at spring wheat yield versus last year, we're up pretty much across the board in the spring wheat states, and therefore production is higher as well. An extra 38 million bushels in North Dakota this year. When we look at winter wheat yields, and here, since we've been getting winter wheat yields over the last couple of months, I compared it to the previous month. And you can see virtually almost every state, not every state, but almost every state saw an increase in yield for winter wheat this month. And production there correspondingly higher as well. When we look at the wheat balance sheet, here's USDA's numbers. Nothing bullish about that by any means. Increasing the supplies of every class of wheat except white wheat. A white wheat, we see a year-on-year decline. That's pretty much it. Funds are going short again in wheat. Okay, here's the wrap up. And here again, you can go to the Q&A session in the lower right-hand corner of your screen, and you can put your questions in. We have several there already. USDA confirmed ample supplies of corn, soybeans, and wheat today. We do need to monitor Black Sea wheat and corn production. Perspectives about inflation have clearly flipped away from reinflation once again. I do expect reinflation to come back over the next 6 months. It's going to take some time. That does lead to more of a commodity deflation theme among fund managers in the near term. The balance sheets are still not immune to a weather problem. So we need to still respect that possibility, but such doesn't currently exist. As such, weather remains the primary focus in the near term. By near term, I mean the weeks and early months ahead. So with that, here's my address on my handle on X, formerly Twitter. But we take your questions at that point, and Victoria, I'll let you read the questions. I think we pretty much answered the first question talking about wheat, corn, residual use, feed usage. So we can take a look at the other questions now.
Perfect, thank you, Arlan. The first question is from Felipe. He's asking, regarding soybeans, when is USDA going to revise down 24-25 U.S. exports and crush and China imports?
Yeah, I don't think they'll do that for quite some time, unfortunately. They tend to be slow to make those adjustments. I think exports will probably start going down maybe in September, more likely October. On crush, I think they'll be slow to recognize that. Now, when they take old crop crush up, if I'm right, maybe I'm wrong, but if I'm right and they take old crop crush up, that may give them the reason then to look at their new crop crush target. And I think that may be the case. Otherwise, if I'm wrong on old crop, I think they'll leave new crop crush the way it is for at least 6 months.
Next question is from Marto. He's asking, why do you think that soybean yields could have a minus 5% hit?
Well, in the balance sheet that I showed, I'm not saying that I think we will, but I'm saying if in that second from the right balance sheet column, I'm saying if we get a 5% drop in yield, this is what would happen to, and maybe I didn't state that well. The one I'm using, and maybe I misspoke there. In fact, let me go back to that and cover that real quickly. If we look at the soybean balance sheet, should be close to it. There we go. What we should be looking at is this right here. And I have 468 million bushels. That's with a trend yield right there, 52 bushels per acre. I'm saying if we have a 5% reduction in yield, it would tighten up our balance sheet. What would cause that would be if we turn off hot and dry in the Midwest in August. Right now, that's not in the forecast, but it might happen. And I just wanted to show it just takes a 5% reduction in yield in order to tighten up supplies. We don't know if that'll actually happen. Hopefully that answers your question, Marco. Thank you.
You got a new one from Dustin. With a lot of acres going in later and the continued wet conditions, one could make a strong argument that 181 and 52 for trend line aren't happening, right?
Well, I hear that a lot, and I understand your question, Dustin. Let me go back here. It's really hard to make that argument when we just said that June stocks report says that last year's 177.3 bushel per acre yield was too low and will probably go up in the September 30th report. We had a lot of adversity last year. And I know that there was a lot of people in the country saying that there was no way that last year's yield was going to be 170 bushels per acre. And now the stocks survey suggests that it was even above 177. And And so these hybrids that we have today, combined with the technology we have for seed placement in the soil, for managing, for applying fungicides, for fertilizer, everything we're doing that the farmers doing to plant, have given these crops amazing resiliency. And so I would say that the risks of the final yield being below 181 are probably greater than the risks of it being above 181 at this point. But frankly, in all of my analysis, I can't rule out 181 bushel per acre yield, or maybe even slightly higher. I can't rule that out.
Okay, next question. How likely do you think the soy and corn yields can be over the trend line, especially corn?
I would put the odds of that below 50%, but based on the current weather pattern and the history, I would still say that there are still 20 to 30% odds that we could be above trend. And we'll have to see how the rest of the summer plays out.
Eric is asking, what is your view of soybean oil from here with the ongoing ramps of some very large RD facilities?
Eric, I'm glad you asked that, because I had a bunch of slides in the presentation about soy oil and renewable fuels, and that's what I took out because I had so much material in there. I've read commentary from the industry that is very optimistic about demand for the biofuels and therefore demand for feedstock of soy oil in 2025. So that's 6 months away. But as I talk to our edible oils team, they're not as optimistic. They're more worried about what we're going to do with the oil that we have on hand, with crush capacity continuing to expand, because all these plants were designed and planned and put into motion when we thought there'd be a very robust biofuel market. That has turned out to be less robust. Some of that's because of technology, new technology development. Some of it, much of it, due to political decisions that have been made. And so our bigger concern at StoneX right now is what we're going to do to get rid of the soy oil that we have. In fact, USDA increased their soy oil export target today as a result. So I'm not very bullish about soy oil prices, but I presented to an end user earlier this week that utilizes soy oil, and I said, I do think we're going to have volatile prices continue, but the funds really moving this market around. But overall, I think we're going to be dealing with a surplus of supply until I see something change on the political front supporting. That's not necessarily Trump versus Biden. I'm not sure there's a big change in their policy regarding the biofuels right now that would benefit it. So when I say changes politically, I mean something that we currently don't see from either candidate right now providing support on a national basis for these biofuels.
Dustin is asking which reference year seems the closest, 2014, 1993, or 2010?
Right now, I've been working off of 2010. I don't know if the climatologists out there would agree with me. I've had this conversation with some of them. But to me, 2010, I think, is the biggest one that gives me concerns.
Julio is asking about the recording. So I just want to say to everyone, we'll be sending out the recording once compliance approves, which will probably be first thing in the morning on Monday. Those are all the questions we had, Arlan.
Okay. I do want to say a few words about the August 12th USDA report. I just look at my calendar, make sure I had the date right. That'll be the first report with USDA changing its yield based on farmer subjective surveys and satellite data. It will also have FSA acreage data. That's planted acreage, harvested acreage, abandonment, prevent plant, etc. So I think we can expect some significant changes in that report for us to work our way through. And so it should be a big report. I look forward to having you all back for that report on August 12th. And I appreciate very much having all of you here for this today, and hope you have a safe rest of the month.